Hello viewers, welcome to the lecture series on financial market operation. Today we shall take up part 2 of the unit 3rd. We have discussed in part 1 about the capital market. So, we know that capital market is one of the fundamental constituents of the financial markets. So, moving our discussion further on the capital markets, let us learn the segment which is important under capital market, that is secondary markets part. It is called as stock market. We know that the capital market has two segments, one is primary market and another is secondary market. So, another name of the secondary market is stock exchange, where buying and selling of securities is being done. Let us have an insight of the stock market. Stock market is the place where buying and selling of stock takes place. Nowadays, due to internet and advanced technology, buying and selling of stock take place anywhere in India and also from foreign countries. There is no need to be physically present in the exchanges like NSE and BSE. NSE and BSE here means National Stock Exchange and Bombay Stock Exchange, which are the two major stock exchanges of India. Stock markets are perfect competitive markets. Now, let us analyze the meaning of the stock exchange. This comes under the treasury sector, which provides service to stock brokers and traders to trade stock, bonds and securities. Stock exchanges help the companies to raise their funds. Therefore, the companies need to list themselves in the stock exchange and the shares will be issued, which is known as equity or a ordinary share. So, whenever there is a listing of any share, those shares of the corporate entity would be dealt in the stock market. The implication of this analysis of stock exchange is that whenever a company is going to list the stock market securities, they can trade their securities in the secondary market. There is a specific definition of stock exchange. Let us learn it. The Securities Regulation Act of 1956 defines stock exchange as an association, organization or an individual which is established for the purpose of assisting, regulating and controlling business in buying, selling and dealing in securities. So, stock exchange can be association, organization or an individual. The role or function which is being done by this corporate body or association is that it deals with the business of buying, selling and dealing securities, and the purpose is assisting and regulating that business. That is what we call as stock exchange. Now, let us analyze the features of stock exchange. It is an organized market. It is a securities market, as securities are traded here. It is an important constituent of capital market, that is market for long term finance. Money market, we know that it is a market for the short term funding, and stock exchange is a segment of capital market where long term financial needs are being fulfilled. It is a voluntary association of persons desirous of dealing in securities. So, again voluntarily people get associated to form the stock exchange for the purpose of assisting, regulating the business of buying, selling and dealing in securities. Stock exchange is a voluntary association. Its membership is not open to everybody. The persons who are desirous of becoming members of stock exchange needs to take the certificate of membership as per the rules prescribed. In a stock exchange, only members can deal in, that is buy and sell securities. So, only a member who is registered with stock exchange can buy and sell the securities on behalf of its client, and they are generally known as brokers. The members of the stock exchange can buy and sell securities either as broker or on behalf of their client. The dealings in a stock exchange are under certain accepted code of conduct. Code of conduct here means there are certain rules and regulations for doing the transaction in the stock exchange. Important functions of stock exchange. It provides central and convenient meeting place for sellers and buyers of securities. However, with the advancement of the technologies, the transactions can be done online from any part of the world. increase the marketability and liquidity of securities. The securities can be easily converted into cash by selling them, and they can be easily bought or sold in the market, as this place provides the marketability to the securities. Contribute to the stability of prices in securities. Equalization of price of securities is an important function of the stock exchange. It also smoothens price movements and helps the investors to know the worth of their holdings. It promotes the habit of saving and investment, as people are going to channelize their savings in the act of buying and selling the securities. It helps in the capital formation, as the capital appreciation would again be going to be invested, and in way there will be a capital formation. So, investors would be getting a help in the capital formation by channelizing their savings. It helps companies and government to raise funds from the investors and provides forecasting services also. If we look to the history of stock exchange, we can analyze that the stock exchange was established by East India Company in 18th century. In India, it was established in 1850 with 22 stockbrokers opposite to Town Hall, Bombay. This stock exchange is known as oldest stock exchange of Asia. Now, let us move ahead and learn another topic, that is trading in stock exchange, that how trading shall be done in the stock exchange market. The market regulator, Securities and Exchange Board of India, which is known as SEBI, has made it compulsory to open the demat account if you want to buy and sell the security. A person wants to buy or sell stock in the stock market has to first place his or her order with a broker, or can do themselves using online trading system. The stock purchased will be sent to your demat account. This process is called rolling settlement cycle. What is demat account? Because the transaction is to be done firstly in the demat account, so we should know what is a demat account. Demat stands for dematerialization. It is a process in which physical paper shares are converted into paperless or computerized form. In India, there are two depository organizations called NSDL and CDSL. NSDL means National Security Depository Limited, and CDSL is Central Depository Service India Limited. They are the depository organization where demat accounts would be taken care of. Brokers and most of the banks provide facilities to open demat account. Now, let us analyze the important terms in stock exchange and in stock trading, because when we are talking about stock dealing, we should know what are the terminologies which are technical in nature and are used in the stock exchange. The first one is open. Open here means the stock price in the beginning of the day, that is morning price. High, the stock price reach at the highest level in a day, and low is the stock price reach the lowest level in the day. Close. Close means the stock price at which it remains after the end of the market timings, or the final price of the stock when the market closes for a day. So, in a day there are so many prices: open, low, high, close. They needs to be monitored for our transactions. Volume. Volume here means the quantity. Bid means the buying price is called the bid price. Offer price means that it is the selling price, and in some of the derivatives it is also called as ask price. Short term trading, it is a term which is used for stock trading done from 1 week to couple of months. Mid term trading, stock trading done from 1 month to couple of months, say 6 to 8 months, is called mid term trading. Now, another part is long term trading. Long term trading is another term associated with investment in a certain period. Stock trading done from couple of months to couple of years is called long term trading. Companies whose fundamentals are good and have good future plans, then the stock of these companies are used for long term trading. Generally, traders having good capital go for long term trading. Another important terminologies are broker and jobber. We have already learned in detail about various types of brokers and jobber in our previous lecture. So, we will just have an insight of the two terms. Broker is one who acts as intermediary on behalf of the others. A broker in a stock exchange is a commission agent who transacts business in securities on behalf of non-members. While jobber, he is not allowed to deal with the public directly. He deals with broker who are engaged with the investors. Thus, the security is brought by the jobber from members and sold to member who are operating on the stock exchange as broker. Now, these are the two terms which are often used in the stock market, that is speculation and speculator. What is speculation? It is the transaction of members to buy or sell securities on stock exchange with a view to make profits to anticipate rise or fall in the price of securities. So, speculation is a transaction which is being done on the basis of anticipation of the rise or fall in the prices of securities. Speculators would be the persons or dealers. The dealer in the stock exchange who indulge in speculation are called speculators. That is, the one who is going to anticipate the price fall or price rise are known as speculators. They do not take delivery of the securities purchased or sold by them, but only pay or rescue the difference between the purchase price and sales price. The different type of speculators are bull, bear, stag and lame duck. We will learn them in detail. Bull, that is also known as teji wala. He is a speculator who expects the future rise in the price of securities. He buys the securities to sell them at future date at higher prices. So, under bullish approach, a speculator anticipates that in future the price will go high. So, he buys the securities to sell them at a higher price in the future. He is called as bull because his activities resembles a bull, as the bull tends to throw its victim up in the air through its horns. In simple, the bull speculator tries to raise the price of securities by placing a big purchase order. So, when a speculator is bullish in approach, what he will do, that he will buy large amount of securities, and when there is a rise in the price, he is going to throw them in the market. Bear is mandiwala. He is a speculator who expects future fall in price. He does an agreement to sell securities at future date at the present market rate. So, here let us understand what is the function of bear. He does an agreement to sell the securities at future date at the present market rate, because as per his anticipation, in the future the prices are going to fall down. So, he will sell those securities at future date at the present market rate. He is called as bear because his attitude resembles with bear, as the bear tends to stamp its victim down to earth through its paw. In simple, the bear speculator forces of price of securities to fall through his activities. Stag, that is dare. He operates in new issue of market. He is just like a bull speculator. He applies large number of shares in the issue market only by paying application money and allotment money. He is not a genuine investor because he sells the allotted securities at the premium and make profit. In simple, he is cautious in his dealings. He creates an artificial rise in price of new shares and make profits. Then next is lame duck. He is speculator when the bear operator finds it difficult to deliver the securities to the consumer on a particular day as agreed upon. He struggles as a lame duck in fulfillment of his commitments. This happens when the price do not fall as expected by the bear and the other party is not willing to postpone the settlement to the next date. Now, let us understand the types of market. First one is the normal market, that is order traded in regular lot size for format shares. Lot size is 1 share. Odd lot market is used for limited physical market order not traded in regular lot size. but both price and quantity should tally with each other. The third one is spot market. Different settlement prices depend on normal orders. Sale and purchase takes place on the same date. That is why it is called spot market. On the same day the settlement is being done. Auction market, initiated by exchange on behalf of members for settlement related reasons. Reasons are shortage and bad deliveries. Loss is recovered from members. Now, let us see what are the big stock markets of the world. They are New York Stock Exchange, that is known as NYSE, Nasdaq America, Dow Jones, S&P 500, Tokyo Stock Exchange, London Stock Exchange, Bombay Stock Exchange India and National Stock Exchange India. Now, the stock exchanges in India are, we already know that NSE and BSE are the dominating players of the stock exchange, then Calcutta Stock Exchange, Cochin Stock Exchange, Multi Commodity Stock Exchange, Derivative Exchange, OTC Exchange, Pune Stock Exchange and Interconnects exchanges are there. Let us understand what is London Stock Exchange and when it comes into existence. It was first stock exchange established by East India Company in 18th century in London. The top gainer of London Stock Exchange is blue chip shares. Stock exchanges position in India. There are 23 stock exchanges in India, but 2 of them are the biggest. NSE is the 9th largest stock exchange in the world by market capitalization and largest in India by daily turnover and number of trades for both equities and derivative trading. It was established by 21 leading financial institutions and banks like IDBI, ICICI, IFCI, LIC, SBI, etc. BSE is the oldest stock exchange in Asia, established in the year 1875 with a rich heritage of over 137 years of existence. BSE is the oldest and NSE's turnover is the largest. There are certain data which are being given in terms of these stock exchanges. BSE is situated in Mumbai. It deals with Sensex, the index is Sensex, that is sensitive indexes is the measuring term. Consists of 30 stock, members are around 852, date of launch is January 3rd, 1986, base period is 78-79. So, it takes the base period for the valuation as 78-79 and the index value is 100. Sectorial indices would be there and the timings are being given for its working. Now, one more important concept in relation to stock exchange is over the counter exchange of India. It is also known as OTCEI. The OTCEI is a national ringless and computerized stock exchange. It was established in October 1990. It started its operation in September 1992. Features of OTCEI is, it is a nationwide stock exchange. Its operational areas covers entire India. It is a ringless stock exchange. The trading ring, that is the trading place commonly found in a traditional stock exchange, is not found in OTCEI. It is a computerized stock exchange. The advantages of OTCEI are: first, it helps the investors to have easy and direct access to the stock exchange. It helps investors to get fair price for their securities. It provides safety to the investors. And it also provides computerized trading system. It also provides investors a convenient, efficient and transparent mode of investments. Now, when we have learned about the stock exchange, all detail and trading transactions details, let us understand that how we need to see the value of shares in the stock exchange. Sensex is the indicator to check out BSE and Nifty is the indicator to check in NSE. So, whenever there is a NSE outlay, the Nifty would be presented over here. the transactions would be reflected in the form of the Nifty. The graph would be a Nifty presentation, while when we talk about the BSE, we will say that Sensex is falling down or Sensex is rising. So, how Sensex index is calculated? Let us analyze its formula. The formula for calculating the Sensex is sum of free float market capitalization of 30 benchmark stocks into index factor, where index factor is equal to 100 divided by market cap value in 1978-79, because we are taking the base year here as 78-79. We will take up an example where security of a company is 300 stocks having value of 100 rupees each, 500 shares of another company and its price is 200. So, this is the market capitalization of these two securities. Adding them up, we are getting 1,30,000. Assume the market cap during the 1978-79 was 25,000. So, as per our formula, this free float cap would be divided by the index. Let us go to the formula back. It is 100 divided by market cap. So, sum of free float market capitalization of 30 benchmark stock. Right now, we are having 2 benchmark stocks, that is 1,30,000. It needs to be multiplied by index factor. Index factor is 100 divided by market cap of 78-79. The market cap of 78-79 is given as 25,000. So, our calculations would be coming as 1,30,000 into 100 divided by 25,000. So, Sensex would be 520 here. This is the way computation of Sensex is being done. Now, students, we are going to summarize our discussion on the stock exchange. In today's lecture, we have detailed analysis of stock exchange. That what do we mean by stock exchange? We have learned that it is a place where the transactions in relation to the stocks and shares takes place in the trading floors. We have also learned important concept about over the counter stock exchanges, and we have learned in detail about the terminologies which are being used in trading, that is prices related terminologies as open, close, high, low. We have also learned about bid and offer prices and the period of investment related terms as short term, mid and long term. We have learned about the speculators and the types of speculators which are there in the market as bull, bear, stag and the lame duck. And we have also learned that how BSE and NSEs are dealing with the securities and how the indices of them are being calculated. With this, we are ending up our discussion on the stock exchange. Thank you.